Hi, I'm Stephen Cruz, and I'm a mortgage broker in Calgary. And I created a mortgage comparison calculator, and I wanted to share it with my clients and anyone who was interested in using it, really. And so I thought I would show you the calculator, where to find it, and what you can do with it to compare your existing mortgage. Most of the time, I use this calculator um, for comparing whether or not a client should pay out an existing mortgage and pay the penalty and go into a new term or a new mortgage, and whether or not it's worth their while. So this calculator helps you out along that case. So what I'll do is I will share my screen here, and then we can take a look. So the calculator can be found at mymortgagebroker.com/why should you refinance your mortgage. And so here is the main page. And then if we just scroll down through here, I talk about some reasons why you may or may not want to refinance your property. For the calculator, basically you can add debt, etc., in there and show what the payments are going to be. Here, what I'd like to do is just show a couple of client examples so that you can see how it works, and then you can use it yourself. So this client has set up a mortgage earlier on in the year, about 6 months ago. The mortgage was set up for about $540,000 at the time, and today the balance is around $533,000. And so on the left-hand side, I put the information that's related to the mortgage today. So $533,000. There's no penalty or premium to keep the mortgage in place, so that's what we're using, zero penalty. The interest rate that they have right now on the mortgage is 3.59%, and the remaining amortization, or the remaining term, is 54 months. And the amortization was originally 25 years, but because I've reduced the payment here, I've taken a half, 6 months off, so I've kept the amortization at 24 years and 6 months, or 24 and a half years, and then the payment will be correct for what they're paying. And so then if they were to pay out the mortgage today and switch it to another bank, then they would incur a penalty. One of the great things about the choice of mortgage they made is they didn't choose to go with a big bank. They chose to go with a smaller lender, what's called a monoline lender. And monoline lenders have a much more favorable calculation when it comes to payout penalties. And so their payout penalty is actually $6,500, which might sound big, but if it was with a big bank, it would have been triple that, actually. So the penalty, it would not have been worthwhile doing this. But because it's with a smaller lender, the $6,500 is what they're going to be charged. Today, the interest rate we could get them is 2.79. So we'll move that to 279 here. Oops, right there, 2.79. We're going to keep the amortization the same to see how much they'll pay over the remaining term. So if this would compare apples to apples, so that if their mortgage, if they kept doing what they're doing right now for over the next 54 months, they would, this calculation would tell them exactly what their balance would be at the end of the 54 months. If they are going to take the new mortgage, then this will tell them what it looks like. I played around with this number a little bit to make the payments similar, but you don't have to do that. So there's 24 and a half months left on the amortization, or sorry, 24 years, 6 months left on the amortization. So to make the payments similar, it's 22 years that I used. So we scroll down here, and then we see the calculations. So we started with 533,000 and 539,000. Their payment's $2,721. And this payment, again, I played around with the amortization. I can increase this a little bit to reduce this number. So I can increase this amortization by a quarter of the year, and that reduces this number by $10 less. I don't know, I'm going to use that instead. The comparison is still $11 more, $10 less. So they're right in that kind of halfway between. So over the next 54 months, they will make $651 less in payments, or $641 more in payments. Over the remaining 54 months, their balance will go down from 533 to 468,000. So they're going to pay off, $65,000 in principal over this time. From here, they're going to go to 454. So they're actually $13,800 ahead by paying the mortgage out early, paying the $6,500 penalty now, and they will have a benefit of almost $14,000. And that takes, this number does not take into consideration this. So it's 13,200-ish, something like that. And so that's where the difference works out to be. So for these clients, it looks like it's a good deal. One of the factors that I talk about in this article that I do use is, I would say, can you recover your cost in the next 18 to 24 months? So let's look, if we put it to 18 months, right here, can they recover their penalty cost within that time frame? And in fact, in this case, they can. They'll recover their penalty slightly, by $1,300 over the next 18 months. So after that, basically everything is gravy, yeah, so it takes them basically 17 months to recover their penalty. It's about $40 difference. So after that, it's better for them. So because they only have a 54-month amortization, the other benefit they're going to get is that they're going to get an additional 6 months at this lower interest rate. And who knows what interest rates are going to do, but they're going to get 6 more months at this lower interest rate. And again, that will benefit them a little longer. So I have another client that I thought I would look at as well. This client's original mortgage, let me just pull it up here. Oops. That's just a little calculator that I use on the side, but their original mortgage was $416, and today they took out that mortgage about 16 months ago. So the current balance of the mortgage is around $416,000, and 416. And this client also chose to go with a smaller lender, an alternate lender, monoline is what we call them. And the penalty that this client to get out of this mortgage, for this client to get out of the mortgage, was $3,250, something like that, $3,250. Her interest rate today is 3.84%. Oops. Oh, yeah. I can't get that right there. Close enough. 384. I'm not moving it fast enough. And then her today, let's just use the same 2.79 interest rate, and so she can get 2.79 as well. She's been 16 months in her term, so 60 months minus 16 is 44. So there's 44 months remaining in her term right now. So let's compare what that looks like. She is, again, a year and a bit, so her mortgage is 23 years left. And let's look and see what those payments are. So the difference in payments is $100. So what I'm going to do is I'm going to reduce this a bit until, as you can see, the payments come down to be as close to zero as I can get. Just going to play around with it. So if she has an amortization of 23 years, 23.75 years, if she was to take the lower interest rate and keep the payments the same, it would actually be 20.75 years. So she actually would take 3 years off of her amortization. And so we can see by these calculations, she would pay, right now, she has $416,000 owing on her house, payments of $2,222, and the difference, I just used $2,216, so a $6 difference over the next 44 months. That works out to be $272 difference approximately. At the end of 44 months, her mortgage balance will go from $416 down to $373, and for 419 to 361. So there's a $12,000 benefit for her to choose to pay the mortgage early and switch it to another bank with a better interest rate. There's only 44 months left, so if she did that, then she would still have another 16 months at this lower interest rate. So she would benefit quite a bit more and extend her lower interest rate for a longer time. So let's also look and see if she can recover her costs within 18 months, because I just always like that number. I've always used that number historically, and within 18 months, she still benefits herself. And let's look at maybe 15 months. 15 months still. So she's actually going to recover this penalty quite quickly. Yeah, so 11 months potentially. What did I put there? 13, and move this to 13. $1,600 difference. So she saved $1,600 on 13. At 11, she's saved 500. So it takes about 11 months to recover this penalty, and then after that, she's all ahead of the game. So that's actually pretty good. When we switch a mortgage from one bank to another, typically the lender will cover up to, or not cover, but add up to $3,000 of the penalty into the mortgage. So as much as I'm comparing apples to apples, saying 416 versus 419, 250, she would have to pay 250 out of her pocket to get this done. If we were to refinance the mortgage under the Canadian rules, a refinance is no longer insurable, and this gets into complications, but is no longer insurable. So therefore, the interest rate is typically a little bit higher if we were to refinance a property instead of just do a straight switch. And there's also some legal fees associated with a refinance versus a straight switch. Lenders will cover the cost of many switches and include penalties up to $3,000 into the switch. So a switch is usually a better way to go compared to a refinance, because there may be other costs that you're incurring. If you did want to do a refinance, add in debt or whatever, then you would just include those costs here. So let's say you did a refinance and you want to include this and maybe some other stuff, then there might be legal fees. There might be appraisal costs associated with that. So let's say it costs her $5,250, or let's say $5,250 instead. So then you can see if there's a benefit, and you can see there's still a benefit when she does that. It's not quite 11 months. It looks like it'll be 12 maybe. No, maybe 14, 15, 15, go to 18. 18 is really the number that I often use. So she'll recover her cost within 18 months if there was extra costs more than just the 3,000. And in this case, there was only a $3,200 penalty that she would pay to get out of the mortgage, and therefore this looks like it's beneficial, and she can extend a lower interest rate into the future. So for this client, that's what I would do. So this is how you use the calculator. I'll put a link in the description of the video. And it is under my website, and the article is called "Why Should You Refinance Your Home Mortgage?" I was chatting a little bit about different reasons why clients do it, and then I decided that maybe I should create a calculator that you can use so that you can figure out if it's worthwhile or not to do that. And I find that this really helps to highlight whether or not it's beneficial. So don't forget to subscribe if you want to see some more of my videos, find out a little bit more about mortgage financing and how that works. I'd be happy to connect with you if you want to give me a call or send me a text. So thank you, and have a great day.